Okay, welcome to the AFS Best Practices Weekly Webinar, COVID-19 Impact on Commercial Lending. Our webinar will be approximately an hour long, and I would like to introduce our first speaker today, Dean Snyder, Managing Director at AFS Vision. To enable open dialogue, we will be unmuting all lines. However, we ask that you self-mute, whether it is on your computer or on your phone. To help us manage those that would like to ask questions or make a comment, we ask that you use the raise the hand feature. Additionally, you can use the Q&A feature to ask questions. Direct your questions to the presenter, and we will leave some time during and at the end of the presentation so that we may answer as many questions as possible. We are recording today's session, and tomorrow you will receive an email with a link to listen or download the presentation. Thank you for joining us today. Dean?
Thank you, Renee. Welcome, everybody. I am coming at you with some live video today from my home office, but mostly because today is a very special day at AFS. April 29th, 1970 was when AFS first started. And so today is our official 50th birthday or anniversary, and many of us I know who are working remotely at AFS are sporting their really cool AFS 50th tie-dye t-shirts for those who can remember the 1970s. So again, a happy birthday to AFS, and I think if I can find this, I will probably turn off the video for the rest of this, and let's get on with the webinar. Again, thank you for attending today. Today's agenda is to focus really on the Main Street Lending Program. We've had a lot of requests from our clients in the last few days and asked if we could walk through a little bit about how would you support this program on AFS, whether it's level 3 or Vision. So we'll be talking about that to the extent that we have the information. I know it is still evolving, and we'll even address some of that at the end of the webinar today. And then we'll let you know some of the other exciting topics that are coming up in the future. Now for today, we've added a new presenter, which is Irene Blake, Managing Director at AFS. And I think some of you probably have worked with Irene, various projects. Irene's one of those people at AFS that's bilingual, right? I think she can speak level 3 and AFS Vision. We have Doug Skinner and Lee Kidder here to provide updates or answer any questions of what they're hearing from the market and from the regulators. And then we have Paul Elmer and Rich Coogan from the level 3 team. So I think they're pretty much bilingual too with AFS Vision. And also Derek Wise, who, as you know, specializes with AFS Vision. He could probably speak another language too, but I think it might be Cajun French. So, but that's a different story. So Irene spent some time looking at the Main Street Loan Program guidance that's been out and put together some slides that we're going to take you through. So again, thank you again, Irene, and we'll kind of tag team on these topics. So as we talk about the mainstream new loan facility, some of the things that have been provided in the guidance documents is the fact that these will be 4-year maturity, amortization of principal and interest deferred for 1 year. We'll talk in a minute about what that might mean. And of course, we've talked before about the fact that there's a recommendation that the pricing of these loans be SOFR based with a 250 to 400 basis point spread. Again, we covered in a prior session the ability to support SOFR today, whether it be simple daily SOFR or compounding in advance. And if you want to go back to prior webinars that are available on our website, you can see some of the specifics about how they are supported in your version of either level 3 or Vision today. And a reminder that there is one convention for SOFR that is still in development, and that's the SOFR compounding in arrears. And AFS will be providing that capability starting this summer. The minimum loan size of $1 million, maximum loan size is that they gave guidance on the size by dollar amount or based on borrower's existing debt and other factors, and the fact that there will be no prepayment premiums or penalties enforced on these Main Street loans. Since they're a critical part of this will be a participation by the Fed in a special purpose vehicle and the various fees involved with that. So the Federal Reserve through an SPV will be purchasing 95% of the loan par value, and the lender or lending bank would retain 5% of that. And this would be done on a pro rata 95/5 basis. There is call for a facility fee of 100 basis points. And there's options. It's still not defined whether the lender will pass this on to the borrower to pay, although I would expect most lenders, if you have the opportunity for the borrower to pay the fee, are going to be doing that. And then there's two servicing fees involved, right, where the borrower will pay the lender 100 basis points fee, and the Fed or the SPV will pay the lender 25 basis points for the servicing of these loans. So we talked about, Irene, maybe you want to explain a little bit the type of structure, how you see the banks setting these up?
Yeah, okay, thanks, Dean. We'll start with on the level 3 side, and this might be level 3 100 rather than 101, but it's important to go through this because there are certain aspects that might impact how you service these loans. On an indicative data basis, division, region, service assignment unit, there's data that flows down. We don't know how each of you manage this because that data you set up at the obligor level will flow down to futures and currents under it. You may have made some changes to currents where you override it for some particular reason. But the reason why I mentioned this here is the fact that these are loans that you might want to segregate into their own portfolio and service by specific lenders. We know other Fed programs are being serviced by special groups within the bank. Not sure whether it's because of the sheer volume and the type of deal. These loans are larger in nature and a little more sophisticated. So, but you can closely monitor these and very well by segregating them out. In terms of the loan structure, these are simple unsecured term loans. AFS level 3 users, you can create a current obligation, just the current, you don't need a commitment, with all the appropriate indicative information described above, plus some other defined data you might want to segregate these for reporting purposes out of level 3. The next piece is the participation sold, and this is for 90% of the loans sold to the Fed SPV. After you set up your new obligor for the SPV, we recommend using the percent sold field in the percent reference. Keep in mind that traditional assignment and GL numbers for part sold will use the same for the borrowers. I'm going to speak to this in just a minute. You may already send them because you might put them in a category like held for sale or ring fence or whatever terminology you use to say, okay, I want to hold these out. And how you manage that will determine how you structure the loan on level 3. In addition, you might want to keep the payments from the borrower due the SVP separately. We know that some clients on all participations take those monies and send them out, do them individually. And we're thinking maybe the volume might be very large here, so you might want to segregate them out and do them in bulk. The traditional part sold, many clients have processed. Here's where I'm going to talk about the held for sale. There are two ways that some of our clients have set up these deals in level 3 in a held for sale situation. One is in a straight participation sold option. They would set up 2 loans, one for the 5% and one for the 95%. And both would have their specific GL classifications. That challenges arise with there, just so that if you're going to go that way, and for folks who have gone that way, it creates some manual processes around an invoicing. How do you get the borrower a consolidated loan? Your payment applications when they come in. If you're going to start restructuring, and it's anticipated that some of these deals will eventually have to be restructured, but it will segregate the monies accordingly in GL. Now, what some clients have done for the purposes of customer impact is they've set up a syndications option. And they've set up the syndicated borrower for the full amount of the loan. And then they set up 2 agents, one for the 5% and one for the 95%. And as you know, the agent shares go to general ledger. So they will bill the customer from the obligor level. When the payments come in, here's where they, again, have to do some manual processes. You have to post it to the borrower to keep them up to date. And then you have to segregate the payments between the 95 and the 5%. So there's, you may add additional operational support for payments, invoicing and restructuring, but the impact to the customer would be minimal. So what we've talked about and found out from clients, you may have this process, any one of these 2 processes in place, which would work fine. We don't see anything in these deals that would make operational processes a little different, except for the fees. And we'll get to that on the next slide.
Yeah, thanks, Tyrene. And then again, don't want to confuse people when we put on here syndications option. So again, we're not saying that this would be a true syndicated loan, but the syndicated process types in level 3 do give you that ability to split your portion into the 5% and the 95%. So that just depends on the bank and how they want to do their GL. If we move on to really the interest and fees and principal repayment, mentioned before, the first year phase on these loans, and I think there's been some questions about when they said no amortization for the first year of principal and interest. Does that mean that the borrower does not pay interest at all, like it's a 0 interest? Or does it mean that the interest is accrued but no payments made, and then starts getting billed after 1 year, what we would call like a deferred amortization? We've heard talk too of possibly the interest accrues for the first year and then is capitalized. So it's paid down and advanced against the principal balance of the loan. So this to us is something that's still up for definition. And Renee, I don't know if you opened up the call or not where people could speak, but if anyone has questions or input around this area, feel free to jump in. But again, we think there's still a definition that needs to be done by the Fed and the Treasury as to how this will work. From the fee standpoint, we mentioned the facility fee. Again, no specific guidance about how you're going to earn that fee, and we'll be watching for more information in this area and what banks are determining.
Yeah, Dean, and one other thing on the principal, I mean, we didn't take it another step, but the principal repayments, they're deferred for the first year as well. So if you're in a term borrowing, the monies that you would normally bill for in the first year, how would you recoup them in the last three? Do the whole amount amortized over 3 years, or whatever? So that's something else that
Right.
was not apparent in any of the information sent out by the Fed.
Right. I did have a question from someone online asking about will we share the deck, and yes, this deck I think actually was sent out right before the call, or will be right after. Is that correct, Renee?
Yes, it was sent out before the call, Dean.
Okay, so if you did not receive it, reach out to us and we can make sure that you get a copy of that. On this slide, we talked again about the servicing fees and the 100 basis point fee on we believe the original sold loan amount. And again, you have options within AFS with your general ledger and your charge codes as to how you're going to treat that fee, how it's going to be recognized, as Irene was explaining before. And then there are the servicing fees involved again, and still some open questions, right, Irene, about how the servicing fee would be set up and passed on.
Yeah, I mean, it's similar to like the SBA processing where you pay a fee. I believe it's on a monthly basis. Somebody can correct me if I'm wrong. But this is an annual fee. Again, we didn't know the sold principal. Is it the current outstanding at year end? Is it the original balance? In either way, we obviously have all the balances you need in order to do that. But it's actually physically getting it to the Fed. Some options would be like you do with your SBA reporting. You've got that fee, you can send it monthly. I'm sure the Fed's going to require some kind of reporting and some number they'll assign it and to track it, and all the thousands of instructions on how to get the monies back to the Fed, which I'm sure they really want. So that's a challenge right there. And how do you set it up on the loan system? So that's another one of your challenges. So Dean.
Yeah, one of our outstanding questions on this is going to be the volume of loans. We know that you're all living through the excitement of P3 loans and having to deal with an overwhelming volume of new loan activity. Certainly the Main Street loans will be much fewer in number, larger in size. So I think that's going to be a factor going into the processes that you identify for handling things like the servicing fees. Some other related aspects of the Main Street loan program is certainly on the workflows that with level 3, those that are using AFS workflows to board loans, the workflows will support you setting up these loans as what we call regular loans. The participation sold portion would be set up directly into AFS level 3 through the servicing screens. So you would not do the participation sold piece within the workflow. You get the loan set up first and then add the part sold piece to it through servicing. Now, there were questions about attestations, and we're just pointing out that you have the exceptions module. Some banks are utilizing that capability with AFS level 3, and certainly the ticklers and the exception messages functions are also available where you can record additional information, data, reminders, and so forth for whatever's required to service these loans. From a collateral side, though, our understanding is these are all going to be unsecured so that there will not be a need for collateral or guarantees or anything in that area as far as we know.
But the one thing that we need to just bring to your attention on the collateral side, you be sure that if you're doing just this term loan, not the extended facility, and you're setting it up under an existing customer, and they've got blanket ties of collateral, maybe for UCC filings or something like that, you have to ensure the fact that you definitely set these loans up as unsecured. Otherwise, the system will include it in its margining process. Okay.
Right.
Just
Yep. Thanks, Irene.
just a little thing.
We're gonna move over to AFS Vision, but I'll pause for a second to see if there are any specific questions from the level 3 clients. And again, if you don't have a question right now on the call, certainly reach out to us individually or through email, and we will certainly attempt to give you a response. If I move on to doing the Main Street loans in AFS Vision, and I've got my buddy Derek here with me to keep me honest too. Again, a very similar process, right, as far as setting these up. Irene, as far as setting up using a part sold structure.
Yeah, it's exactly the same criteria. The one advantage that Vision, one of the many advantages Vision has, is in the Vision system at your customer and obligor level, we have lots more ways to define the customer and where they sit. You don't have to use user-defined codes. We have lots of user-defined areas for you to segregate these loans into their own portfolios, and again, following the flow down structure. But yes, in part of the loan structure, we're going to use simple unsecured term loans, but I'm going to say unsecured, but these can be secured. That's one of the biggest differences. These are the extended, they're taking an existing credit and enhancing it in essence. It can be secured or unsecured. So if it is secured, then you have to make sure that you include the Fed as an equal partner in terms of the risk. The Fed's being particularly strong about the fact that these credits have to be on par with each other in terms of their risk and reward. If you go into some restructuring, that collateral, the Fed is an equal participant in terms of position with the bank, and it has to be first in line. So we're not necessarily going to get into all the credit aspects of this, but keep in mind, we have to update this to say it's both can be secured and unsecured.
Okay, thanks, Irene. In terms of the structure, again, to set up and selling 95% of the loan to the SPV, Envision would be set up as a traditional part sold structure. Now back to that second question on the structure of if the bank wanted to separate the borrower loan into a held for sale and held to maturity pieces in general ledger, we talked about a way of doing that by using a syndications process type to accomplish it in level 3, and then the same thing would exist for Vision. But Vision also provides you a unique feature where you can split the principal balance on a single loan into more than one principal balance, so 95% one balance, 5% the other, and each of those balances have their own separate GL codes and assignment units so that you could get your split GL reporting and processing. I was talking to Derek a little bit about this. I know for our current AFS Vision clients, I know there are sometimes some challenges with using multiple principal balances with your downstream systems and interfaces. You probably are aware of what those considerations are, but just wanted to mention that. Is Derek, did I cover that correctly?
You did, Dean. Absolutely.
Okay, thank you. And again, similar process in Vision as far as the handling the principal and interest billing and the servicing fees. You have all the flexibility of AFS with your separate charge codes and with your flexible billing schedules so that you can handle that first year period, or whatever the final definition would be. Again, a couple of things with vision that are different than in the level 3 is when we talk about on this slide, the first bullet, talk about the 100 basis point fee. Remember that in vision, we've brought assignment unit and GL number, not just the different balances on a loan, but also to the individual charges. So it gives you greater flexibility in terms of mapping your fees to appropriate general ledgers. Again, the servicing fees would be similar to what we covered in level 3. And again, with the workflows, you have the ability to, here in Vision, is book the loan through the origination process or post-approval process in AFS Vision, and then to be able to build in the part sold piece of that through the servicing function, or if you're going to use the syndication process type option that we talked about, you have options for how you would want to go in and set that up. So, I think, Irene, attestations collateral is similar.
Yeah,
Correct.
yes, yeah, except that in the AFS origination, you can take those attestations and put them in the
Right.
covenants area, because they are kind of like covenants.
Yes.
So you have those that the bank must follow, but also there are those that the customer must follow. So you can track them in there as
Okay.
well.
I think someone, I might have seen some, was it Dana that raised a hand? If you have a question, feel free to jump in.
Yeah, it's actually Dawn, Dean.
Dawn,
and-
okay.
Yeah.
Sorry, they flash up very quickly on my screen.
No, I know they do. She needs to unmute herself. I've unmuted her, but for some reason she's not. She's not.
Okay.
Unmute.
Well, we'll go on, John.
Okay,
Just
hold on.
feel free.
Maybe that's
You
her.
can,
No. Okay.
you
Yeah.
can jump in.
Sorry.
Irene, do you want to cover this
Yeah.
slide for me?
Yeah, sure. And as we said a little earlier, when we went through it and started analyzing all of the immediate requirements or characteristics of the loan, we noticed that there's only a couple of differences between the loan facility and the expanded facility. And in the expanded facility, the loans can be secured or unsecured. And again, as I mentioned earlier, the bank and the SPZ, they have to be on a pro rata basis where the collateral value is concerned and position. And then the loan sizes are a little larger for the expanded loans and maximum loan size. And here's all the requirements. It is a little different. But the actual loan structure, principal, interest, and fees are the same in AFS Vision as was executed for the new loan facility, including processing and support of the collateral origination workflows and attestations. So once you set up your process about how you want to handle most of the aspects of it, it applies equally. My personal view is that from the credit side, there's a lot more requirement, not necessarily for functions, but from definition and who can apply for the loan, what are the parameters, questions about the credit risk, which are the things I see out there for complaints about things that have to be addressed where this program is concerned. But in terms of how the loans are set up between level 3 and AFS Vision, my view is that the one big determiner will be if you want to segregate these loans in a held for sale account. And that certainly is up to you, how you want to manage it. Okay, Dean?
Okay. Thanks, Irene. Yes, and I think in terms of where we are with the process for the program, I believe Doug may have whatever updates have come out, certainly in the last day or two. Doug, do you want to weigh in on what you're hearing or seeing?
Sure, Dean. So as I think, as you mentioned at the outset, the Fed continues to solicit a wide range of feedback on this Main Street lending program. In just a week's time, they actually received over 2,000 comment letters from various stakeholders throughout the industry. And the comments seem to touch on nearly every aspect of the program's initial design. I did want to mention just a few key aspects of the program that are receiving most of the attention, because they'll probably give us some insight into how the structure of the program will likely change before it's officially rolled out. One common comment really is the proposed use of SOFR as an index. For most, if probably not all lenders, SOFR is an entirely new index, and they've yet to modify their systems to accommodate it, or so they're telling the Fed. The comment letters have noted that requiring the use of SOFR would also result in the need for significant borrower education. And they're positioning that as just adding a unnecessary complexity during an already challenging time. So the feedback is that many of them would prefer to use LIBOR or Prime or some other relatively common index. And if they went with LIBOR, for example, just use fallback language that would allow for SOFR as an eventual replacement rate. Price, yeah.
Doug, can I ask you a question about that? So do you think the pushback on SOFR is as much it being different for the borrower, or is it partially confusion around the compounded and arrears methods? Because we feel like in Main Street, they're talking about SOFR daily simple or compounded advance, which really is like LIBOR. It's just a different index rate that you're using. Is there still pushback for those, or is it mostly the fear of having to do this compounded and arrears process?
Well, I think there's a couple things, Dean. I think for AFS and the calls that you've had on this subject and our customers that are on those, they've been talking about this for a couple of years, right? So there's been building comfort, I guess, if you will, and a path forward for how to address those. Across 2,000 comment letters, there's an awful lot of people that have really no insight into whatsoever into who the ARC committee is, for example, and what they're doing and why they're doing it. That's certainly reflected in the comments. But also, I do think it has everything to do with that. Not so much operationally, but educating their senior management, their board of directors, and their sales staff, and certainly their customers around something new and different. So
okay, thank you.
Yep. On kind of related to SOFR, the pricing in general is also being reviewed. The Fed's has provided a proposed range for spread pricing, and there are comments kind of on both sides of that. Some want to lower the price to attract more business. Still others that want more flexibility on the upper end, although I'll say for those that wanted flexibility on the upper end, they're typically from non-bank lenders who actually at the present time are not even eligible lenders. The minimum loan size is another topic of conversation. A lot of these comments are from people in Congress, actually. Under the initial terms released by the Fed, companies would have to borrow at least $1 million to participate in the Main Street program. And many think that's too high, that it would eliminate many businesses that still need smaller loans. Another area the Fed is looking at is borrower eligibility. I think that this is certainly an area that could potentially find ways to expand. If you recall, the Main Street programs establish debt to EBITDA ceilings that determine and really limit the loan sizing. And those limits as they currently stand are going to eliminate some borrowers and some high-risk industries. So under the current criteria, many retail businesses today, many hospitality-related businesses would likely be ineligible for a Main Street loan. Certainly many oil and gas companies, particularly if they're in oil field services or exploration and production, they would not qualify for Main Street loans under the existing pricing criteria. So from a borrower's perspective, right, if you were a company that was in a growth phase prior to the onset of the pandemic, maybe you were a startup backed by venture capital, or maybe on paper you had limited cash flow, but in other ways you were in good financial standing, your business is not going to qualify for a Main Street loan. So I think what the Fed has to consider is if it looks like banks are only going to extend loans to certain industries, industries that they see as relatively less risky, or there is less uncertainty maybe about how the coronavirus would impact that sector's viability. Do they change the terms, or perhaps do they give the banks some flexibility to adapt the terms to different borrowers in different industries? So one of the suggestions that's gaining some traction, I think, is to ask the Fed to kind of tailor the leverage requirements to different industries. So you're starting to see maybe a bit of a pattern or a theme emerging here with some of these comments, where the industry wants more flexibility to negotiate the loan terms for the Main Street loans, or even just tailor them in some small way to the needs of the individual borrowers and different industries.
Yeah, thanks, Doug. I'm sorry, did you have any other points?
The one other thing I wanted to mention that I thought was interesting, Dean, is just last week, the Fed announced that it will disclose on a monthly basis information on borrowers who are going to tap their emergency lending facilities. So the SBA did not take that step with the P3 program, kind of left it up to the discretion of the borrowers to disclose that. And you saw some of the controversy that came out of seeing who received the P3 loans and who didn't. So the Fed plans to disclose the names of the Main Street borrowers, the size and the interest rate of the loans, and it'll be interesting to see what kind of effect that those disclosures have on demand, and if that plan discourages any companies from borrowing, or at least thinking twice about that.
It's very interesting perspective on that, Doug. Also, AFS, of course, is a very active member with the LSTA, Loan Syndications Trading Association, and I know they're lobbying very heavily around the restriction on these loans being syndicated. So that could be I think that's another area that is being looked at. I'm checking a question I've got here. And I might ask you, Doug, because I don't know if you see this or not. Have you heard or been provided any additional clarity from the Fed or Treasury on will each of these loans be funded at time of loan or group funding or end of month by the Fed and Treasury due to liquidity challenges? Also hearing that the participation percentage, a change is being discussed there to maybe lower the percentage down to even 80 to 95%. So have you seen anything along those lines, Doug?
I have not. Nothing
Okay.
Definitive.
Well, we appreciate the question, and we will certainly continue to look for things like that. Upcoming webinars tomorrow, Doug and he's part of the business intelligence team, is going to be presenting an update on the commercial loan pricing. And again, a lot of good data, a very interesting report that we'll be issuing. And I believe it's 1 o'clock tomorrow. And again, the registration details are out on the website. We will switch to going bi-weekly with these sessions on COVID-19 unless something changes in the market that warrants a sooner next meeting, but otherwise we will be looking at May 13th. On May 19th, we will start our first session in the AFS Leadership Summit 2020 virtual series. So in replacing our in-person gathering of the AFS Summit, we'll be switching to virtual sessions, starting with a topic on AFS Vision Cloud technology. And on the 21st, we'll be doing a joint AFS RMA risk analysis service update. And then we're trying to squeeze this in, as you can see, the calendar's getting busy, with a specific LIBOR SOFR update. We might even supplant that with some just email updates, and but we're continuing to stay on track, on schedule for the delivery of the compounding and arrears changes for SOFR that are coming out this summer. I know you've all been extremely busy with the P3 program. I can tell you that monitoring some of our vision clients between two of our banks, I believe they have booked and funded more than 40,000 P3 loans, totaling well over $7 billion in outstandings. And so I know even with the level 3 banks, there have been some incredible numbers that are getting pushed through the process. And I know everybody's probably pretty weary of trying to get through this, but it's a testament to our banking system and all of you on the phone for what you're able to accomplish. So we on behalf of AFS recognize that and appreciate that. And again, if there's anything we can do to assist in any of these areas, please continue to reach out. Renee, did I forget anything for today?
Nope, you got everything, Dean. And just as a reminder, we'll send out the link for the recording of this session, as well as the presentation as well.
Yep, there's plenty of places to stay in touch with AFS. You'll continue to hear about our exciting 50th anniversary year and more events around that. So thank you very much. Have a good rest of your day.
Thank you.